Hey guys, how are you? Yep, I'm going to talk to you about HVF method and the value of a price line, a horizontal level that is known at the beginning from the outset from any given trade with a known prior to entry determined stop loss, prior to entry determined target, and a working just in time entry or a return move entry if you've just missed the break. So that's the value versus some other models that are utilizing what I refer to as either angled trend lines or arcs, which are even more vague. They don't have a fixed gradient and they have a rolling movement up. Now, I don't know the fullness of this model. I've got drawn into this and I responded not realizing that I was actually copying both people in as well. So I didn't mean to hurt anybody's feelings. This is not a personal attack. In fact, the person's behaved rather well and is reasonably creditworthy. So there's no bads here, but it's to highlight the difference of our approach to something that I consider far more vague and flexible, which allows way too much wiggle room for the model owners to continue to put it out. And we saw a lot of this with stock to flow. I'm pretty sure I speak under correction, but I'm pretty sure he said, you know, we're at bottoms. The second time we went to 30K on BTC after the 69,000, then we heard it at 22K. I don't know how many times, and they kept recycling the model and tweaking it, and they seem to be able to generate a variety of range of numbers, all of which failed. And now they seem to be a lot quieter. I don't know, maybe I've been blocked because I copied him in once on something when Real Vision mentioned us both, and just that seemed to maybe upset him. I don't know. Anyway, so the questions Nav asked here is, what do you think of the LGC model? Very little, because I don't know much about it, is the main answer. I am just making off the top response to what I got shown, because I don't know what the LGC model means apart from that which I saw. So I saw the associated tweet that was sent out now 3 hours ago that showed this diagram, which essentially, if you can't see this, I do hate black background charts, but that's other people's business. They can write and draw charts exactly as they want. I'm sure many of them don't like what I do, but in essence, I've sometimes drawn this when Bitcoin was topping at the 64, what I call the bent banana, which shows a convexity, so a slowing of an exponent to a reducing. However, I want to highlight this is log scale that is here, and this is, I will be referring back to that as well. And then in a similar way, you've got a line that almost goes near vertical. In fact, it looks like it goes backwards at one point, then comes around, all the way around, you know, designed to put a permanent sleeve on things. And as a result, I think this is, he's making a bottom call here. Funnily enough, I don't think that's necessarily too far off eventually happening. I think there is some signs that the volatility is reducing. I think we may get another sell. We'll show you the Bitcoin gold, but this is essentially a Bitcoin video that you're going to be watching, and a differential between this kind of modeling, not an attack on the person involved at all. As I say, he's conducted himself quite respectfully. There's no grievances here, versus just as a nice alternative that we can juxtapose HVF method against. So just so incidentally turned to be this particular individual, Dave the Wave, and he's been around consistently for a long time. He's not, he's not behind any scams or anything. I think he's a legit crypto guy, finding his way, trading and forming opinion and having followers and a newsletter, all good, no harm and no bad in there. So my response was initially just thinking I was responding to the person who questioned it, just off the view of that chart that I just saw, is the curve seems to, and I have seen it once or twice. So it's, I'm following a number of people, and I think this is one. So I have seen this windsock that going over it, the bent banana, that now I know the name LGC. I'm sure I'll find out what that stands for in the same way people wonder what HVF stands for. The curve seems to fit on a dynamic adjusted basis, but I didn't see anyone calling the 64K top of range off of it. So I'm saying, I didn't hear anyone say 64K. They were all, most people that I heard were 100K callers. That was not specific to this individual. I don't know what he called, and I'm not saying he called that. As I say, it's not a personal directed attack. It's just my general observation of most people whilst we were hitting the 60s was 100K by the end of the year. That's the general gist. It's not a specific, it's a general comment. So the more bullish things are, the more bullish people get that they supersede. We saw the same in the Dixie when we had the 111 target. People started calling 120, 150 for the Dixie. I mean, like, that's some move. So you see it across all markets. Neither did they call the 16K lows when it was 55K either. So they will bend it over a little more if we trade lower. So my general comment, not specific to the individual, is that people tweak their model, because the whole concept is, instead of a price level that is hard and agreed early, that is a horizontal line, you're actually having arcs and waves on incredibly tight increments that are all log scaled, where you go from 5,000, 20,000, 60,000, 150,000, all with similar increments, but the amount that it is moving is substantially more. So there's an immense amount of wiggle room, and then there's an arc, and the arc can be mildly adjusted, but it can actually mean a massive amount in thousands. So this is what I call the wiggle room modeling concept. It always looks in hindsight very intelligent, because it's fitted. It's called curve fitting. So early on in my trading career, there were always computers around and all of this. There was optimization. There were a lot of things. And with optimization, you essentially curve fit your trading strategy and adjusted all the variables, so it gave you the best performance. And the computer would calculate what that would be and just all your variables. Metastock could do this quite a long time ago. Trade Center, or what's it called? Whatever. I'll remember the name. I even had them for a while. I tried all these things. And all that actually happens is you get a brilliantly set system for the data set you gave it to curve fit. That's all that happens. So it gets highly optimized for the history that you've given it to work on, you know, the last 10 years of S&P 500. Well, that's going to perform terribly for the next 10 years of S&P 500, because you're not going to get the exact same data again. So actually something that would have performed less well and been more general and forgiving would actually perform better on the following 10 years. So that you've got to be very aware of these curve fitting concepts. It's incredibly seducing, and it brings people in. And ironically, we're talking about curves on charts as well. So, and I'm talking about optimization using AI and machine learning, which is only getting stronger. And so he's saying stood the time or test of time for 4 years. And my point was, actually, these charts are moving. They are actually moving. So if I see, yeah, someone saying I was on point, near 60K, not good enough. So he said he called 60K. So I actually went to these particular charts and I clicked on them and had a look, and there's two of them. And what you see here, and let me just expand that, because this is the problem you have. This is very small. The chart you're capturing 2011 in terms of screen space, because people are insisting on using MACDs. And the people that follow me for a long time know where I stand on moving average, moving averages generally, and moving average convergence, divergence, as a rule. So actually only a small percentage of the available space is actually the chart. That's the full space, and the bit of interest is actually stuck in right here. And the log scale is that's 6 cents, that's 20 cents, that goes from 2,000 to 6,000, that's 20,000. I actually don't know what that number is, and you can't assume it's 60. It could be 70,000, it could be 65, it could be 75. That is 250,000. So between these levels, you've actually, in the bit that we want to see, you've actually seen, you've already seen quite an immense amount of density of value. So you could make any number cases for any value of numbers. And what I did is I said, well, you're drawing a channel up to the line. You will note that this high at that time was not on the line. And I drew this because I like to be accurate. This is the kind of guy I am. And when people are insisting that they correct, and I'll show you what he said, that then made me a bit belligerent to make my point. Because generally I don't get too belligerent. I don't try to teach the world anything. They're going to find their way. That is actually, that top is not on the top of the green line that is drawn. And the actual top, where it intersects with that line, is on this range that is drawn. And it's quite hard for you to see this. I might have to magnify. I'm not sure if this is going to work. You might be able to see that that top over there is not at the top, and that the pink line actually represents the expected top in what was a channel going up. That's all I can interpret from that. That comes out somewhere over there. So let's give him the benefit of doubt and go the lowest possible round number. Let's say it was 60, which I doubt because it's only $250 away. And that is significantly more than $250. But you can see there's a difference between the two lines, between there and there. And I don't think that's $250 because we're going up real fast. We're ending up at 250,000. So that pink line over there, you're going from, let's say it was 60, go the lowest possible number, to 250. You're going up $190,000. So what is that value? It's anything you want it to be. It could be 75 or 90. It could be 100 for that to be 250. That's assuming the number underneath that is 60K. And that this big area there is only $250 between the hard line and there. So if it's 75 or 70, it's already short. And it's difficult to know what the exponent is and what the gradient. So the concept here is he's already bent the curve, because in the drawing that he provided, claiming he's called the top on that within a couple of miles, a couple of yards. Don't be cheeky, don't be cheeky, don't be cheeky. Here we go. Here's the one that's the claim. It's a different chart. It has moved slightly. In fact, this one is at 61 and the banana is not there. So that's not the chart. On this one, he's making the claim MACD on the monthly flat lining. That is not a top call. That means that it's the MACD's flat lining. And the point I made is you had a period there where they flatlined and they ran together, which coincides with a piece of price action there. And you had a sustained period of there or thereabouts there, which coincides with a piece of price behavior roughly there. So any low volatility period, which is sustained, you were drifting off slowly. Of course, you had the COVID dip there, which that's when it got a bit high drama, but that was generally, given Bitcoin's macro, he's taken such a long view, we're starting at 2011 here, that's a low volatility period. So you ended up having MACD's flatlining there. But so what does it mean? That wasn't a local top. The local top was there, and that clearly wasn't a local top. So the question is, are we MACD trading, or are we the magic banana trading? So the MACD's, there's nothing to make of this. It's the third instance of something that twice before was irrelevant. So again, if that's proof of a top call, I don't agree. A top call, say, is something, not only do I think this is a localized high, I think this is a final high, and we do not trade above this level again, and we will be looking at sideways and down for hereafter. Something like that I will give a man you called the top on that, especially if you're later at 16K. No bear call came at all. So the claim is that the model has been flawless for X number of years, and that a 60K call or near 62K call happened. Well, that chart was at 61 and he mentioned something about a MACD. It wasn't a top call for me. It's flatlining, which usually means the price is slowed down in its movement or its volatility. Its volatility more than its movement is quite low, that the slower version of the moving average, convergence, divergence, is actually getting very similar, and they are flatlining with each other. So the volatility is low. You could be inching upwards in a low volatility manner. You could be going 100% sideways in a low volatility manner, and you can actually be drifting downwards, all in a low volatility manner that could see your MACDs have quite a sustained period, which is one of the reasons why I don't use them. And I disregarded MACDs about 15 years ago. But nonetheless, people will feel insulted if you say that, because it's almost like you're attacking them because it's a tool. And I don't mean this as a personal attack. See all my previous YouTubes that I've done on moving average and everything, and you know, cows pull behind trucks and the cows actually steering the truck through the muddy, slidey field. No, I'm sorry. Price pulls the cow. The truck is pulling the dead cow out of the river across the muddy field. The muddy field and the skidding around, the cow is slaloming behind the price. And as long as that farmer boy keeps his foot nailed into the bottom right corner, that rope stays tight, and the cow generally will follow the price, give or take a little bit of slippage to the left and to the right. That's how it bloody well goes. Moving average crossovers do not signal future price action. The farmer boy turning the wheel and flooring the accelerator is what determines a future price action. You see it later on a delayed and lagging basis. Anyway, I don't want to go into a moving average rant here. Nonetheless, so let's just move on. Like I say, good-natured, there's no grievance with this. He's a gentleman of the realm and all of that stuff. The other point I make here, I made that point. I also highlight that the macro has come much more into play, and that it's all about dollars. So there's people that saying they're still talking about 4-year cycles a lot. It's a case of, you're telling me the dollar moves in 4-year cycles as well now? Because the Bitcoin absolutely had its run on the destruction of the dollar with 7 trillion. It took 7 trillion this time to pump Bitcoin from that COVID lows. And I think that 7 trillion only came out when it was at about 10K. So for us, the real break took from 10K. Most of this was recovery of an extreme event, March 2020, for which you all know. So the breakout for us on the first cup gold nugget, which is something, again, I will refer back to because these people don't recognize it. And you can see their model stopped working and they started talking about irregularities and extensions and all of this. No, you've got a macro 2.5-year continuation pattern embedded. It's the first time that's ever happened. You see, everybody has a simplified model, which is bull. Let me do this in nice, fat, greasy, cokey, so it's there for everyone to see. Bull, bear, bull, bear, bull, and off you go through the top. That's how they see it all the time, until suddenly it isn't. Until suddenly you get something like what Bitcoin did. 2017-18 high, down, flatline, dip for an extra low. Then a secondary high, but failure to take out the new high. COVID crash down, up, down, and a major 2.5 year of a lot of people getting very frustrated continuation pattern. That then was waiting, and a company needed the weakening dollar, 7 trillion print, boom, and literally you start going from there. Bang, bang, bang. There she goes. And actually, during this period, we were highlighting that as the dollar was gaining momentum and turning, as per our macro dollar 111 Dixie call, where you saw 114 on overperformance, The dollar was about to become dominant. At this point, that's 46, by the way. We were already bearish on Bitcoin. We were highlighting that you were flat and leaning down on a dollar that we expected to go up even faster, meaning that Bitcoin would go down. So, you know, the relationship between the dollar and Bitcoin is underspoken about, and the 4-year halvening cycle is overspoken about. Anyway, so that point made, I'll just expand that so you can see. Whoops, let's just turn the jaw off. So conceptually, I want to make the point that curved lines, that says 46 in there. It's really tough for you to see, but take it from me if you can't. I'll try to help you in there, but that's about as big as I can get it to go on the Wacom. The pixelation's getting really crap. Okay, so and I mean we were short from 55. We said that's not right. It's rolled over now. It's no longer going to keep going higher. So when he asked, "Oh, you care to retract that?" That's a little bit. I didn't mean to copy him in because I would have maybe been more sensitive in my wording, but that's a little bit confrontational. The curve seems bent to fit. So first of all, was the curve bent to fit? So let's deal with each point, because if I've said something incorrect, then I should retract, shouldn't I? And if I've said everything accurately, or I can justify it, then actually, no, I should not be contracting. I'd gone on to highlight while he was, before I saw that tweet, the role of the dollar, and actually highlighting it's come into play far sooner than people arrived. Whenever you had, from around here, from around 2014, whenever you had a major move on the dollar, it was not a toasty period for Bitcoin. There's another major move on the dollar, not a toasty period for Bitcoin. Here's a major move for the dollar that initially had an up and very quickly turned into a down. And that was all the momentum people that were chasing in on the 64K and got it to 69, and then bang, absence of bid. So actually, you can already see dollar surges, which have not been that common, but we've got 3 distinct phases, 2 of them very distinct of some scale. Here and here. So 4-year cycle be damned, the dollar's far more relevant in all of this, as far as I'm concerned. In this, and we can also see the same thing. Let me take a different color. Dollar weakness, I'll even fatten the line up a bit. A very clear-cut period of dollar weakness was indeed super supportive for the Bitcoin bull period of the late 17, mid 17, in fact all of 17 into the 218 high. And if we look at the sell-off here, that was the 7 trillion. And that's what it took, by the way, to get from the 10K level, round about here, once it was announced, all the way up to the 64,000. And you had an echo bounce that just barely took out the previous high with a 69K. So actually, the cycle is more about what the dollar was going to do, as to whether people are thinking about dollar replacements. Kind of makes sense to me. So here's my comment on this, and this is the big chart that I drew. So am I retracting? Absolutely I'm not. In fact, let's rather have a look at my actual hard copy version that I shared of this. So this is a huge difference in value. This could be 10,000, that line, and I'm on a fat line here, so let's just go back to skinny ones again. That top there, which actually is not on the green. So the more recent example that he shared, he said almost 60K, he shared this. Well, sorry, it hasn't made your value up there, which is a lot closer to that. And you're highlighting that you got a channel up, and that is shaded. You can see it's shaded like that. So you were expecting that, which is the pink line there, which is somewhere between 250K. That's the 250K mark. As I mentioned, I don't like and this is the 60k mark, or a bit lower. It's literally superimposed. If that is 60, we don't know. So overall, this could be 75, it could be 80. That's got to get to 250,000 by the time it gets there. So where's 100 grand? You know, 100 grand. If it's exponential, I think it'll be 100 grand will still, even if this is 60, it'll more of the value is near as you get there. It's really hard to see. So it's any number between 75 and 90k, that pink line for me. And that was 64k. So that's quite a lot of wiggle room. You take that as a percentage, you 64 versus 80 or 85k or 90, you're about 36,000 out. That's 50% on top of its existing value of 64. So that's the problem. And the point I was making is also the point regarding the bend. So the previous, so we'll just remove those. The chart, so this was the chart that when I went to the tweet links that he said, but the chart he was actually sharing when the entire narrative began highlighted that in fact now the 64k is pretty much on the, is this the current one? So first point, this line goes out. It actually goes backwards in time and then goes vertical and then curves back. So I mean, as an arc, it's quite reasonable. Why does it perpetuate like that? Why can one not even assume that it will eventually start coming back on itself? It could go vertically down, and if it does what's on the other one, it could actually arc backwards in time, because that's gone out backwards in time. In short, the curve wanted to start somewhere over here. So first of all, going backwards in time for a line, I mean, it is whatever you want it to be. And now the implication is that that's kind of the top. That's what that fib is highlighting. That's kind of the top. I'm not sure actually if this is the particular draw, because there was one that I think that was it. It's not, neither of these two have actually met the top. Neither that nor that have met that. And by the time you're here above that point, that's substantially higher than that on a log scale that's going up at that rate. The problem is this is all so compressed miles away over here on an incredibly dense scale where millimeters is tens of thousands. So it can be whatever you want it to be. If you build in enough vagary and compactness in something and you present it like that without a zoomed in shortened time frame, neither of these tops have actually met the other side. So he couldn't have called the top, because he shouldn't have called the top, because you've either bent the curve, which this draw doesn't show sufficient bend. It's like, oh, it's close enough type thinking. And this is again the vagary. It hasn't. So it's either the curve's been bent and is where my blue line is, or it's like this and it's not been bent, but you called the top before you even made that level. Well, why did you wait until that touched, and that was there before this going backwards line that then later went vertical and around? So this is not a model. This is a diagram. That's the most I can say for it. It's a diagram that is seeking to fit localized highs and localized lows in any shape, arced structure with an arc, not straight lines. Diagram. It's a diagram. And the notion is this, the assumption, and this is where all diagrams will fail, and it's rich to call it a model. I know there's fibs going on there and everything, and it's all so nice, but it's a diagram, and the assumption is you're going to remain inside my magic banana sock. And every touch, or if not quite a touch, hey, whenever, is a localized high, and this is a localized low. Well, for me, you've already broken through this now, because we have had below 16.5, and I would guess that you're going to get plenty closes below this. Now you can argue, well, that looks like you had a bit of candle action below there. Otherwise, none. Otherwise, you know, just did this. You had wick action at that point. At some point in COVID, that was all red, but it's a wick trimmer. I get it. We trim wicks on big time frames too. But the point with this is there's too much fudge. There's too much wiggle, and the assumption is you're going to stay in there. Well, that's an assumption about the dollar as well. And that's assumption about a hyperbolic new amount of money that's required every time to push up Bitcoin to newer highs. It takes more money, significantly more money. So yeah, so this is not standing the test. It's not standing up to robust test. You didn't make highs here. You should not have been expecting a down leg. If this is the model where that was a touch, that was a touch, that was a touch, that should have been occurring there. And there's a massive difference, as I've already said, not to over egg this. That is close to, I would imagine, if that's 65, it looks like there's a 5 there, 65. I would guess 65. That would have to be 110, 100 to 120, I would guess. That's where he should have called his high. On that basis, because you've already taken out this high. So this is the key bull move, unless you have another pullback and another further go, which would only see you get a more time elapse, and as a result of time, the further you go right with time elapse. So if you do this, marginally higher high, and then another pullback, the even further later you will go, the even higher this number becomes. So you can't call a high, you can't start with a fixed value on an arc that has an ever-changing plot, because you don't know how long something will take. It's a function of time, the target, if you make it there versus the one you make it there, it's hundreds of thousands apart. That's probably 350 grand. So the whole concept of arcs across varying lines allows a lot of wiggle room for analysts and market commentators to assert that they are right. And people want followers and asserting that they're accurate and they have something that works and that their tool is. And in some way I'm doing the same. So let's be candid. We're all interested in making our case for what we think is accurate. But that's clearly not acceptable. An arc is any value. It's a value up here at 1,600,000, and it actually went backwards on the other drawing. It's not doing that here. This has at most vertical, and then it's coming back. So, you know, it's a sleeve. It's essentially a diagram connecting previous highs and making the assumption that a continuous gradient that they've assumed will continue to be met in an environment where it's already proven to have failed. So no, I don't retract, because it's failed. By your own diagrams, it never made the boundary of your sleeve. And due to the scaling, the full scale of that miss is not clear to your followers, that it is vast differential, where you have between 275,000 and 65,000 in 1 inch in a 1-inch box. That's about half an inch, and that's another half of an inch. That's a 1-inch box. Neither of which, you didn't even get into that box, starting from 65. The high was 69, and none of those are on the green line. So it's a fail. It's a fail, and it's a fail by quite some way. And the thing is not to acknowledge it's a fail, it's to keep believing and saying it's good enough, it was close enough, we called the top 62. I don't see that. I don't see how you call the top on that. That's 64, that's 69. Where's the 62? It's not anywhere on that sleeve. Anyway, so I think I make that point hopefully pretty clearly. So MACD on the monthly flatlining, we saw that. So let's just say that there's no visual of the sock anymore. The arc, just the MACDs. So that was a MACD point, which we also, in my opinion, have debunked. 2 previous events, neither of which were meaningful or localized highs. So what's the significance of the third one? It turned out that in this instance, in retrospect, that was relatively close to 69,000. It was 59,000. Okay, so you at a point that you point out that an indicator was flatlining, which could mean it's grinding very slowly and very low volatility, hence the moving averages are very close to each other. There's not a lot of new deviation, there's no volatility. Does that mean a low volatility period can be a continuation pattern that pops up higher? It can be a grind sideways that just breaks up and gets more volatile up and down, or it could be a low volatility period before smashing down. You didn't say. It was not a top call. I gave an example of what's a top call. So that's not acceptable. It doesn't stand up to, it certainly does not stand up to normal level of endeavor, never mind a scientific level of endeavor, which is pretty tough to do. So what was here? In my opinion, the top chart shows, okay, so let's go up here. I want to follow this. So if it was a peak, so he's seeing a shooting star there. If it was a peak, well, why is it a peak? It's not there. It should be there. That should have been there, just nestled under the 100K mark. That should be 95,000. So the SOC is irrelevant. Don't say it's 4 years proven, hard, battle tested. If that's the top and it's going down, what made you think it's the top and it's going down? Because it's not complying to that. You've got a shooting star, it looks a little bit tired, you've got marginally higher highs. Actually, he's seeing the short-term technical analysis and he's drawing the rising wedge, which we saw. So actually patterns do hold value, and he's recognizing the value of patterns because he's drawing a rising wedge and there's a shooting star there. So he's not SOC trading and he's not MACD trading. The thing that actually was right was pattern trading, which is what we are, pattern traders. It's grinding higher. It's got a basing ascending grind line that is creeping up higher. It's losing momentum. It's making marginally higher highs, and it's getting big pushback on a reasonable time frame, which was 1 month. You've got a shooting star. That's what it. So the bearishness. So taking the lines of LGC, but you're not trading LGC. You're trading at a rising wedge and a clear technical candlestick signs of loss of power and momentum. So that was that chart, which we've already seen. So now he's referring to the breakup of the old cycle. So he's losing confidence in the cycle that he had. So again, it's not battle tested. If it's now, hold on, it's going to go on for longer, we're expecting longer cycles, etc. And that's what comes up later. He was actually talking about lengthening of cycles. This fortnight article look at exactly this. Realistic sketches future, except a little skepticism towards the over-optimistic calls, and all should be relatively well in the land of Bitcoin. I'll focus on the notion of cycles. a lengthening cycle theory as applicable to Bitcoin for some time. So we started to see this. The general assumption is there are cycles that work in Bitcoin, with my particular variant being that they may be lengthening. Now, remember, with an arc, the minute you add time, you're also adding a higher value, because you're moving more right with the time, a lengthening of cycle. The sleeve is continually on an upside trajectory, on a very intense logarithmic, going up ever more by the millimeter in terms of value. The general assumption is the cycle work of Bitcoin is all around halvening through the early parabolic spike in the 2019. Mini parabola threatened to invalidate the theory. So this is threatened to invalidate the mini 2019. So this is the bit where the guys don't realize that they're looking at a 2.5-year continuation pattern, and all they want is, and this is causing them doubt, the pump, the bear, the pump, the bear, and then the bull, and then they wanted another dump, and then this confused them. It's a continuation structure, the largest that you've ever had. And then you got the largest dollar QE print, and that took all that force to get you there. That was at 35K and up top here. Now, where would that have been? This can be anywhere. At that point where he drew it, it's at about 90,000. Again, a fat line. Let me just do it like that. At the point of the line that it crossed the sock, windsock, that might be the most accurate possible call on a diagram, because that's at about 35, you're at about 45 there. I would say that's about 75, 70, because you're getting denser as you go closer to here. Remember, so that's 20,000, 45,000, 30 will be closer to the 45,000 than the 20, because you're getting denser as you go up. But it's any of a number of places, and this is far too vague. Again, this brings me back to point number one, which I'll not rehash again. So to me, you're not adhering to your model. You're extending the time frame for it, which means you're extending the value, because you don't have a fixed price. The difference with HVF method is we have, before the break, an entry, that's a level that we'll enter, that is known. We have a actual stop placement. With this additional squeeze, you got an improvised additional stop benefit that was down here. So you could have had your stop a lot higher here, because you got a micro setup within the big setup. This is the first cup gold nugget. The fact that it broke early and ran, which was part and parcel of the QE that got passed, that you didn't have a further deep dip. And the other reason you didn't get a deeper dip on the high 3, deeper than this little fractal, is that you had an excessive dip on the RL2. So such was the extremity of that. It truly cleared out all weak hands, and only tenuously had people got in here. So there wasn't any hot money that needed flushing out for the RL3, and you got this fractal. So you had a stop here, and you had an entry. You could have got in on the smaller structure, roughly there, or you could have waited for the big one, and you would have run it all the way to there. And if you missed it and it came back on the second chance, you could have run it from the second chance all the way to the same target. Those two lines that are in pink, that I've overwritten in blue, are your lines of efficiency. It's how much juice you're getting on squeeze, and that was the key moment where we said holding overnight sustained leverage positions will benefit you. Now, we've made it a small change that only our premium community will know in terms of our big time frame setups. Some people, if you want to guess in the comments, can leave a message what you think it is. But the target here, 56,532, was your best exit. It was on the right shoulder of a head and shoulder of a grinding higher rising wedge, which he also spotted as a pattern trader too, or someone who is pattern aware. He's not a pattern trader because he's trading, or he's investing maybe, or trading the sock, the bent banana. And you then got your head and shoulder, and you then got your falling wedge. We made the head and shoulder target. We said that's as far as it goes. keep buying the dip, everyone was wetting the bed, and you broke up to the upside. Now you're in the bigger head and shoulder, and that one's neckline is here, and you still have that target to make at 15,146. It's our expectation that'll be run, and there's the possibility of the 12,100 on this big bear flag. Now the head and shoulder is a stronger pattern than a macro bear flag, but I wouldn't rule out the macro bear flag happening. And if you have a terrible run in, you could be back in this funnel, which would be very bearish, because it took 7 trillion being printed. Now obviously that didn't all go into crypto, but there was a flush of liquidity everywhere. Risk on, ARK went up, Tesla went up, FANG stocks went up. They got a lot of that. Some of it was spent, etc., etc., etc. But people also invested in crypto. They were risk seeking, they were seeking yield, and they were risk on. So that's a value. You get your value, you go long at 10, you have your tight stop in and around the 9,000, and you trade up until the 56,000. That is a risk reward that is known in advance. Now that gradient, you were out February of 21, guys. You would have left this absolute mess. From February 21, the market was a dog's basket. Let me just tell you, the market was a goddamn dog's basket. This is what happened from there. First major volatile hit, apart from your second interim pullback, which is standard on the way to target. Post target, major hit, marginally higher, another major hit, marginally to the same level, not higher, substantial hit. So you went from 56, you actually traded 29. You missed all that garbage out. You could have got long again on the falling wedge call that we made. That was a technical call, and ridden up that again. And had you got out at the same target again level, you would have executed exceedingly well. You would have gone there, you would have had one pullback, and you would have gone. Much like your only main pullback coming at your second interim, where we expect that to happen. And you would have sat all this garbage out. You might have got 2 runs if you really wanted to be playing. You would have sat all of this out, unless of course you're a shorter like us, and you went short. You went short on the break of the flag, you went short on that structure over there, and you went short over the breaks here to the downside, and many alts at the same time. That is true stop, known, risk reward known, because you have a hard, fast target. There's no fudge value on 56,532. By the way, that's on Bitfinex. It's higher on other exchanges. You've got to do it on the exchange that matters. There's no fudge. It either makes it or it doesn't. It fails or it made it. It's a yes or it's a no. It's not came close to the arc, passed through the arc a little bit, just a wick, or passed properly and closed, but only for a short while, like it is on the bottom, and goes under and under for a few candles on the lower end. Well, shouldn't you be out? Hasn't your model failed? What's it mean? Here, you make it or you don't. It's honest. If you don't make it, it's a fail. The pattern failed. That's feedback. That means the market's not as strong. It's not you failed. It's not the methods failed. It's a market information feedback system. You made the target, but you didn't have that much overrun. And then you had your first substantial pullback that actually ran you below your second interim that turned into support. So that is in essence something that is tradable. It has a full prior knowledge risk reward ratio. And by the way, against gold, it was even better performer. So let's just illustrate this. This is meant to be digital gold. Meet the physical gold, and that's your same first cup gold nugget, and this is how it is now. And the guys are bottom calling, and I'm saying shooting star, minor little hammer, hammer run. Saying you're putting your neck out there a little too soon for the bottom caller. The train's still going fast, you're going into a tunnel and you're sticking your entire torso out the window. You could just get a fuck slap to the side of your head, that one you would remember for a very long time. And you might be missing a few vertebrae in your neck. That doesn't mean you're going to be wrong. Could happen. It's lower vol, but every time we've had a vol, for now we've got low vol, we're broken to the downside. But eventually some bottoming will occur. I'm not as aggressive a bear now on Bitcoin as we were earlier with the higher volatility. At some point we bottom out. But the point I'm here for is to show you what you achieved. On the previous one, you were out in February the 21st. Just go back to the dollar one. You actually were not very long in that trade, leveraged, and you were done. You actually sat out all of this garbage if you weren't a short trader. You sat in stable coins till today, from February. Okay, most people aren't patient enough, so you either would have got shorting on the bear side, or you would have tried to make money long in shit conditions and lost some of it and given back. That's what truly happens. But the system can't be blamed for your emotional immaturity. So I'm sorry, we are working on decent operator standards, and I often miss that myself. So let's go back to here. So the time frame was not long. This was done and dusted. Look how quickly you're done and dusted. That candle takes you out. That is holding it perfectly vertical, and you are again out super quick. You could have closed all your longs on crypto, including your Bitcoin, in that time frame. Remember, if you're using Bitfinex, Binance, well, they are still charging you every day to give you leverage. You could have levered up 3x, 5x, I don't know. Some people go crazy X. That's up to you if you understand money management. But this was an almost single-minded up, except at the second interim run when you expect to have your pushback. That's how we train you. Everybody good? Everybody good. By the way, what I call the Michael Burry head and shoulders, he doesn't know how we do it, actually would see a return to here, which is very similar to this flag. Again, that's not a call, but it's a threat. That's that head and shoulders. We've drawn on this one, this head and shoulders, and you can see post the target run, progress decay, you had an extended period of churn and holding the level. Then FTX news came out. Great joy. Down she goes again. So this is unbelievable target fulfillment. In fact, the secondary high, this is a weekly time frame to get this entire structure in view. Let me just highlight to you that if you got out on that purple line, there literally were no closes significantly beyond that level. 34.58 ounces. Again, you would have got in a little earlier if you were optimizing it and you're in our advanced group. You could have had a stop there in gold ounces. That would have been around the 5.45. You could have been in around the 5.81. 34.58 ounces in gold. And you could have said, that's it, I'm done. What's happened? All the way back down to 9. 1 Bitcoin buys you 9 ounces of gold. When it broke, 5.5. You could round trip. There's two things that are giving you targets that could fail, both of them. So that would be a monarch head and shoulders. It was the first, and that would be a far larger one. Only we know how to target off these, and I'm not getting into that detail here. You can find out on a program, go to themarketsniper.com. But I can tell you that it's down here by the axis, and you also have that flag down there. That would bring you back down to 5 from 9. So that would mean you're going to lose 40% in gold versus Bitcoin value. So that means a combination of gold going up and Bitcoin going down, if that was to be made. I'm not saying it has to be made. Please understand. And there are some signs, as I say, the volatility is reducing. It can bottom before that. And that would be a sign of bullishness. Two bear patterns don't make their targets. So if that occurs on balance of probs, back to the funnel, you're talking about another 40% relative loss. So that could see gold go up 20% and Bitcoin go down 20%-ish. It could be a combination of gold just holding its value and Bitcoin losing 40%-ish. It could be a combination of gold going down 10 and Bitcoin going down half. It could be gold going up 40 and Bitcoin holding its own. There's many ways that cross valuation can change, but this has been an unbelievably tight pattern. And that turned into a bit of a double top, by the way, with that in the middle. So you also, within all of this, have a number of other structural patterns. An M top. And that double tops in and around 16 from about 34.5. So you can find out more about other structures that are giving downside targets and where they're all building up, because often you get a confluence of patterns, and when you get verification as a confluence of patterns across multiple time frames on cross assets, this is the value of HVF method. We do it across all asset classes of relevance. 360-degree analysis. How many of these guys are doing TA even on the euro, apart from the dollar, for Bitcoin? I don't see one Bitcoin euro chart a month. In fact, every 3 months. I don't see a Bitcoin GBP. I don't see a Bitcoin JPY. I don't see, never mind gold, silver very often, or NASDAQ. I mean, we are the most prominent 360-degree analysis Bitcoin relative valuation guys with legit pattern trading. Do you just want to look at BTC USD being fitted into bendy socks where people don't even apply their own rules and say, well, we didn't quite touch the other side, but yeah, it's a top. I called it. But you're not trading what you're drawing. So what's the point? Okay, so that's Bitcoin, gold, and that's what I had to say on that. This is doubting your own model and planning for extensions and more time, and that is just wiggle room. It's all wiggle room to keep it going, to keep the game alive. And the best thing is we should never tell ourselves lies. It fell out of cycle. I had a COT indicator. It stopped working, 100%. 100% stopped working. The data got changed and it stopped working. And it worked brilliantly until it didn't. And I dropped it like a piece of turd tool. And that's the right thing to do. I will occasionally check if we ever get any decent data back, and I'll relook at some of the ideas in time. But it's a mess now. And they changed the data and they cocked it up. And some things might work under certain circumstances and cease to work. So some of you will say, well, what about your HVF method? That is totally geometric and it's timeless. It works in equities, it works in commodities, and it's a feedback mechanism. It's totally honest. And you start with a existing risk reward, you know in advance. You know where your stop is, you know where your entry is, you know where your target is. And they're all substantial numbers. And you are trading a volatility constriction into a volatility expansion. You're not trading big broad bands with exponential scaling on multi-year charts with wiggle room to infinity. So he got more answers than I think he wanted, and he went away. Bless him. But the problem is, if someone, it's like a provocation to ask me to retract, because what you're saying is you spoke shit, admit it. And I absolutely don't spend time talking shit to anybody, particularly somebody who has some credibility or following. I choose my words carefully, and there's usually some meaning. So for this to be a brilliant, legit model, the model is saying you're at the bottom, you're already running through it. Let's find the sleeve again. Not that it's being traded very adhered to, but if we get one where we have the current price, none of those have the current price. I think I have to go back to the main. But when people slink off and they don't want to fight any further, it's because they're dealing with someone who spotted the vulnerabilities and they don't want to over highlight that. So they'd rather go quiet and let it go away. And it's almost like it's almost like the vaxxers. Don't tell me that choosing the vax was a bad idea. It's easier. It's that old saying. It's easier to fool people with models because it sounds scientific. So it's a diagram. Than to convince them that they've been fooled. And some people want to remain inside the self-fooling because they've got an order to the universe with what they've done. Even if they're calling tops on candlestick analysis and patterns, not their top end of their range. They wish to sustain the comfort blanket, and moving averages are definitely comfort. I used to call them the comfort blanket for placebo traders, moving averages. And it's quite ironic that there were MACDs involved in this particular example, and for me this is a comfort blanket, because actually it should have bounced by now. Because you've got a close below and you're currently trading below. This wasn't a close below, that's a wick. I'm allowing that, fine. That's a wick, I'll allow that. But there were bodies underneath that. Your curve didn't quite do that, sorry, but there were green ones, so let's wiggle that away, shall we? What is the rule? I mean, is it a candle close below the line for the buy? Well, you've got two candles below the line and a wick there. It's complete fuzzy logic, and the problem is the margin for error is huge. Where's your stop? Where's your trade to high? And where's your reward? And do you know it before the trade so that you can assess the juice is worth the squeeze? Don't know the stop, don't know how far I'm trading it long for, don't know how long for. We trade fast moving breakouts that are typically very quick, and we have a time stop criteria where the trade will close if it has not made its objective. It's not stopped out, it's not made its objective, it's closed. There's carry costs, there's opportunity costs, there's everything. Where are they? Where are any of these things? We have a risk reward divided by time. We draw the time stops in our community. When something vacillating and gesticulating and no longer making real progress, that is often a precursor to a change of direction. It runs out of time on our setups. How do you determine that? We have rules, and they work, and it's geometric. It comes out of the logic of the charts and the price behavior that's gone before it. Anyway, so that's my 4:39 a.m. in the morning. Can you believe it? This is the things people that are passionate about charts and trading, and an attempt to get people focused on logical things that there's always a clear wrong and right. You've got to have a clear point where something is proven wrong or right. And that is a feedback mechanism. It's not a failure point. It's feedback. When something is proven wrong or right. So he's talking about the dollar. Not much has changed. I'm not sure what he's referring to. Although some semblance of correlation should be argued, so I've covered that. Not much has changed. The debts are even bigger and must be monetized. Dollar moves will be relative to other currencies, not a pro-BTC. Dollar's move is a financial instrument. Bitcoin is priced in dollars. As much as people think Bitcoin is universally of itself, people want to know its dollar price. How much has it moved? So dollar strength absolutely matters. I'm not sure what he's saying. The fact that it's more indebted doesn't mean the value of the dollar won't have up legs. We released 6 or 7 trillion. The dollar went down and then shot up. This is after introducing new currency. After introducing 7 trillion, it then subsequently shot up to 111 on an upside HVF that we called in advance, with a known target, with a stop, and said to you it will happen in quick succession. And that is the Dixie chart. And you can see it. That's that 111. You can see the 110 there. And we were waiting for this bottom. We were in early. There's an inverted head and shoulders on there. So I don't know quite what that guy's part. Not a pro BTC. I'm not. It's not about being pro anything or against anything. It's about charts. Stop being a believer or choosing a team. I support Liverpool Football Club. No one cares. No one really cares. In markets, I'm not a fan of anything, and I'm not an unfan of anything. I'm into what the chart tells me it's likely to do next on a completely dispassionate, uninvolved, non-fan approach. There's way too many Bitcoin fans, I can tell you that. That's why I look like a hater. And someone else has to then say, if he tweets me, I'm not a pro BTC guy. He's not. You're welcome to be a pro BTC guy. Just, I would personally suggest don't be a believer in anything. They're never going to let you have your own money. They're never going to let you have your own money. They will never let you have your own money. This is a new asset class of digital assets that they'll decide is either a commodity or a security for most things. At the moment, they're treating Bitcoin as a commodity. And when the dollar weakens sufficiently and goes into a sustained period of weakness, it's quite possible that the crypto market will turn. And that's not got anything to do with the halvening cycle, even though in many instances, some of the halvening cycles start to contain. And especially if you say, oh, it's certain weeks before the halvening cycle, or the halvening's just happened, or it's the 6 months after the halvening cycle, bloody hell, you can blot out an entire year as your reason why Bitcoin's going up. But it's if the dollar's weak, it's good for risk on. But right now, in a tightening interest rate environment, a shit macro environment, recession, dangers all to the downside, they're going to tighten until something breaks. Actually, money runs to the dollar when the shit breaks. How's that going to feed your Bitcoin? That's all I'm saying to you. Fundamentally, and technically we'll see. At the moment, the dollar's not that strong, but I'm not sure it's going to stay that way forever. It's not that strong at all, particularly against the Asians. It's giving up ground against the Korean won. It's not that sexy against the Japanese yen. We can have a look at it. But the point is, these answers are, that's not a method. I'm sorry, it's not a method. And it's unfair because it looks like I'm shitting on someone. A decent guy with good manners and all of that. I don't consider that tradable. I'm sorry. And that's not a knock on him as a person. I mean, I traded MACD switching systems. I traded with a stochastic momentum, RSI. I did every indicator. I traded Bollinger Bands. I did them all. I tried everything. I wanted to know. I wanted to understand. I won a little. I mostly lost. Let me tell you, I became a luckier trader when I predetermined an entry, not a buy at market. I predetermined an entry and entered on pending orders. Number one, it's a number one rule of HVF method. 2, I traded less often, only when I had much more discipline and a higher degree of certainty with macro time frames at my back, not a 15-minute and a 1 hour. I had the whole, I did 4 time frames, 3+1 time frames of analysis, and they were all turning up. I got a whole bunch lucky. I divided the number of trades I did by 3. I traded much less in terms of entries. I did much more looking, much more charting, much more 360-degree analysis, much less trading. The work isn't the trading. The work is eliminating all the fluff that takes away your few good trades profit. That's the work. And I got luckier. I got bounced into mergers that were happening on equities I knew nothing about because I was trading HVFs, constrictions and volatilities before hyper expansions. I got bounced into events. We were short when FTX happened. Of course, I also had the wrong exchange as well and made a donation to the Democrat Party. But many instances, we had all sorts of events. We gave everyone a Binance and then we said, close it at target. We gave everyone a Binance dominance. What happened? Its biggest rival got taken out. And Binance made its target. Now it's back to cuck again. So, method will give you the future because the insider money moves first and it's the big money and you will see their fucking footprints in the sand when they're moving. This is the epistle that you need going into 2023 for your crypto trading, for your FX trading, for your anything investing. You don't have to be a trader. I don't have 9 screens here. I've got 2. I could probably do without the other one most of the time. Don't fuck your eyes up. Truly. Look at big charts. Make 3 to 4, maybe 5 big decisions a year. And I'm busy designing and discussing the macro movers for 2023 across all markets that I see, up and down, not loving any of them, not, oh, I'm being mean because that one's going down and oh, I'm being kind because I'm calling that one up. Take all the emotional shit and baggage out of here. There's a time to own gold. There will be a time to sell gold. There will be a time to sell silver. There will be a time to sell all the things you've heard me be bullish. And there'll be a time to buy all the things I've said are cuck, or low, or not in tune, or not right for now. And we'll buy crypto again, the ones, the survivors, but I do think there'll be a lot cleaned out. Anyway, long video, but a big heads up on the way of the world as I see it. The value of method over arc lines, true price levels. key levels of significance geometrically generated from price behavior targeting, with interim levels where you just look away and go for a walk. Nothing good's going to happen for a while. Stick to process. You submit to process. We started and we did the psychology one. I did the first part on atomic habits, and I said to you, all of you, I said, listen to me carefully now. You've got to change who you are inside, then you've got to adhere to process, then you get the outcomes. You don't work on outcomes. You work in, out on the 3 circles. The inner part is, who are you? You've got to speak, I am becoming a trader, if you don't yet feel honest enough to say you're a trader. I am becoming a trader. Become that person who is a trader, who cares about charts, loves the process, applies a process, shows discipline, good biology, mentally coherent, not coffee and cocaine and jittering and must have action and adrenaline, not the casino effect, not the gambler effect, coming in with logical reason, followed through process, 360-degree analysis, macro chart, full trend view, pattern view, and micro timing. That's what we do, the 3+1 time frames, every single time. And then you optimize, entry matters, you squeeze that risk to the best place, but still standing behind a concrete fence that you have a sluggish chance of surviving, and the chart must move instantly on break away from you. Otherwise, it's probably wrong and you're taken out quickly. All our losses are over very quickly. It's like wrong, done. That check got cashed that I wrote. No worries. But our winners are long. And you know what? When they did a study on investors and traders, all their trades generally were long, and their losses were cut fast, always very short. And what do? You hang on to your losers. You hang on, you hodl your HEX from 51 cents down to sub 1 cent. You hodl your Bitcoin from 69,000 down to 15,000, and that could go still possibly lower. We have, as I say, you can find out about those additional targets. Go to themarketshyper.com, book a call, have a chat, start your new trading world from this new year. There are going to be unbelievable opportunities to the downside as well as the upside. Most traders do not make money shorting. They can't short. They don't have a method for it. And the markets always rally too hard. They don't have a process. Where do you put a stop? Where do you do it? Most traders haven't made money shorting. Some of my best trades have been shorts. That they happen faster and more furiously. In fact, I've got more shorts on now than most things. Most others just stand back. I don't know how to do that. I can't do it. I don't know. Yeah, anyway, so endeth the epistle. Thank you for checking in. Appreciate all your likes and shares that you've given us over the course of this year, and all your participation with us. Focus on method. Become a trader. Start with that. Work on the micro atomic habits of being better, checking everything. Write a process and a list. If you're not coming on board and you don't know what we are all about and some of the things I've said that you should be doing, write a process, write a list, trade less, don't enter at market, have pending orders with a reason as to why. Know your stop and have it pre-entered before so that you can get off the screens and eat lunch. You're not going to get killed, murdered, or washed out, and have a target. And preferably have most people's stops absolutely do damage to their trading. You need to have them in logical levels which have a fighting chance of surviving. That is why we trade volatility constrictions to expansions. We are the only ones that have done this. There are many people that are now trying to follow us and are copying. They don't have the skill sets, but it's still the best place for them to hunt. I'm happy for it. Okay, till next time, we'll see you. Thanks for sharing and liking, and we'll call it a night at 4:51 in the morning. Bye for now. Enjoy all the best for the 2023 to all of you, by the way.